ticker symbol MSCI has returned just over 4% in the past year, and this is due to recently having reported earnings and the stock dropping around 10% in one day due to earnings not matching the expectations that the market had in place for the stock. However, today we'll be looking at a highly profitable company which has a very wide moat, and why it was actually ranked a 10 outperformed by tip ranks based on an analyst consensus moderate buy and a bullish blogger sentiment. So today we'll be looking at MSCI Inc., a financial services company. So in their annual report, they define themselves as a leading provider of critical decision support tools and solutions for the global investment community. So in English, I'm sure you all investors have seen an MSCI index before. So basically that is one of their main services, along with portfolio construction and management tools, and also private asset data and analysis services. Some of their key client types are asset owners, which could be us investors, asset managers, financial intermediaries, real estate professionals, or even corporate firms. They have a strategy which can be folded into 4 different parts. The first one is to extend the leadership in research-enhanced content across asset classes, meaning that they actually want to keep researching and investigating the returns in different asset classes to provide more value and make better informed decisions with their clients. Then they want to expand solutions that will empower client customization. So in regards to their portfolio construction and management tools and private asset and data analytics services, they want to actually provide as much of a customized service to their clients as possible based on their clients' financial goals and their different risk profiles. Number 3 is that they want to strengthen their client relationships and of course grow into strategic long-term partnerships. For example, their main client, I believe, is actually BlackRock, and the most part of their revenue actually comes from this partnership. And number 4, to execute strategic relationships and acquisitions, so inorganic growth. Now, I know this company is not the most interesting company in the world. However, when we break it down and look into their financial analysis, they become even more attractive, as they have a very, very good return on capital employed of 28%, where we usually look for companies with a 15% and above, so a 28% is amazing, with an interest coverage ratio of 8.2 times, meaning that they won't have to worry about debt in the short term. However, I usually like firms that have an interest coverage ratio of above 10 times. Now, their cash conversion is sitting at 81%, which is pretty solid, especially for such a consistent company, with insane profit margin of 77% and a very, very good operating margin of 60%. So very solid ratios all across the board. And the fact is that this company is a growing machine. Their net income has grown by 32% year over year, and their net margin has even risen by 16% year over year. We can see the jump from September 2023 to December 2023, where they actually increased their pricing model and therefore increased their net margins, while at the same time increasing their revenue for those same quarters. And the fact is that every single metric you can see here has improved every single quarter. So they are the definition of a compounder. And now in terms of their balance sheet, here is the one red flag that I have actually spotted with this company, in the fact that their total liabilities are actually higher than the total assets, and they have traded like this all the way since 2018. Now, of course, this is not harmful when you're trading like this in a period where interest rates are below 1%. However, right now that interest rates are a lot higher, this could get ugly and this could be a bit dangerous for the company. However, they are so consistent with the revenues and free cash flow that this shouldn't be a big issue. Now, I just want to mention it since some investors like myself are really picky with their companies having strong balance sheets. And the same way, we can see that their equity is actually negative, which is a red flag in my standards. Regardless, their efficiency ratios are doing incredible and are extremely consistent, with return on invested capital sitting at just above 35% and increasing every single quarter. Now, when looking at their fundamental analysis, this company gets a very solid 7 out of 8 ticks. Now, the first one being it's having a low liability risk based on their interest coverage ratio and the fact that they have very stable income. Now, I gave them a cross for a solid balance sheet as they have negative equity, and that is a no-go for me. But they do have extremely consistent cash flows. They do pay a dividend and they offer share buyback programs. Now, this company, of course, has pricing power. We have seen that they actually changed their pricing model and still were able to increase their revenues that same quarter. And of course, they have organic free cash flow growth, which is driven by their insane organic revenue growth. Now, this company has an existing moat and a very strong competitive advantage, as the majority of their revenue is actually recurring revenue, and this has been caused by two major factors. The first one, their ability to create long-term partnerships like the one they have with BlackRock, and second one, their solutions and their offerings being so high quality that all clients want to actually stay with them and not switch to different financial services providers. So I see this as one of the best competitive advantages a company can actually have. Now, in terms of dividends, they actually pay a very solid dividend with a 1.2% dividend yield and a very low payout ratio of 39%. The payout ratio is basically how much of their free cash flow or their net income they're paying in dividends, meaning that they have still remaining about 61% of free cash flow or net income to either invest back in their business, buy back some existing shares, or even keep increasing their dividends. And as we can see, their dividends per share are actually increasing at a way faster rate than their amount paid. Why is this? Well, this is because of their recurring share buyback programs, something that allows the company to give back their free cash flow to their investors at a faster rate. And now in terms of valuation, this company is actually trading extremely cheaply right now for the high quality firm that it actually is, trading at a PE ratio of just around 30 times, which is extremely low comparison to the past 4 years. Now we can see that this company has a free cash flow yield of 3.2%, which is higher than the long-term inflation rate of 3%, also suggesting that this company is at an attractive valuation. And the fact is that I see no major risks and possible challenges for this company, as in terms of a worsening competitive landscape, I believe their competitive advantage will defer any other companies from stealing market share away from them. They have extremely solid partnerships with long-term huge clients, and those will not be going anywhere as long as MSCI keeps operating the way that they have been operating and actually return the value that their clients are actually paying for. Now, in terms of regulation, this could be the one that hurts them the most, but I still wouldn't be worried about it. And this is just possible upcoming regulation changes to the financial world. Now, in terms of performance, this company is rock solid and has been meeting performance objectives for a very long time. And I don't believe that economic downturns or cyclicality of the economy will actually hurt their revenues. So before moving on to the investment conclusion, please remember that I'm not a financial advisor and this is not financial advice. So please do your own due diligence. However, I believe that this is a very solid, good company as it offers a wide moat and has a strong competitive advantage. It has consistent and growing cash flows, which are extremely predictable, and it has extremely high return on capital employed, meaning that it can create value for the investor. So overall, I believe that this is a very good company and will possibly be a great investment. However, the negative equity and its very weak balance sheet is keeping me away from the company right now. Anyways, thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic.